Of cash equities trading. I'm Anna Edwards, live in London with Tom Mackenzie.
Here are your top stories. Decision day. Investors await any changes to the ECB's bond buying program as rising Eurozone inflation energizes the hawks. Takeover turbulence. EasyJet says it's rejected an unsolicited approach because it undervalues the budget airline. Plus, Morrison's misses. The supermarket chain disappoints with its earnings. What impact will that have on the bidding war for Britain's fourth biggest grocer?
Let's put all that together then and have a look at where that leaves us for European equity markets and the start of trade then this morning, Tom. European equity markets just 10 seconds away from the start of their European equity trading day, and futures decidedly negative. It seems that globally we're caught in a bit of a negative mindset when it comes to risk assets. That certainly was true in the US session on tech stocks, true in the Asia session, and now true perhaps into the European session. Certainly futures point to the downside, Tom.
Yes, certainly you saw that concern percolating through the NASDAQ in the US yesterday. Facebook and Apple were dragging on that index. Then you had it handed over to Asia, where that focus once again on the regulatory front on the big tech names of Tencent and NetEase. Regulators there warning them on profitability. So let's switch focus then to Europe, where the handover is negative again. The stocks on the FTSE 100 down 0.9%. We have those question marks about the airline industry and EasyJet and that unsolicited takeover bid that we mentioned. We also had, of course, Andrew Bailey from the BOE suggesting that the minimum mandate has now been met. The conditions have now been met, pointing perhaps to a rate hike from the BOE next year. The IBEX over in Spain is down 0.8%. The CAC 40 is in similar territory. The focus, of course, here in Europe on the ECB, the decisions around whether or not they reduce those PEP bond purchases. Commerzbank telling us earlier they think they're going to go from 80 billion to 70 billion. How will that impact the financial conditions as we look ahead to APP? Rate rises from the ECB, a very, very distant prospect. That is the consensus. Anna.
Right, so European equity markets then opening to the downside, Tom. That's after stocks slid the most in 3 weeks in yesterday's session. The Stoxx 600 has struggled for traction since hitting an all-time high during earnings season in August. And US equities could be the next to falter. Strategists at Goldman Sachs, Morgan Stanley and Citigroup have all issued fresh warnings on the potential for negative shocks to end the relentless run-up, seemingly relentless run-up in stocks stateside. Risks include the spreading Delta virus strain, a flagging global growth recovery, and moves by central banks to exit pandemic-era stimulus programs. Let's put all that together. Think about where we have appetite for risk assets with Freddie Late, Latitude Investments CIO. Freddie, very nice to speak to you. So let's take the big picture on stocks right now. How concerned are you about days like yesterday for European stocks, where we saw quite heavy selling without many people being able to identify exactly why that was? You know, is it really the Delta narrative in Europe? That's clearer to see in other parts of the world, perhaps. So what is it, do you think, that's causing this negativity around risk assets at this point? Is it just because it's September?
Good morning. I think a little bit of it is that people are coming back to their desks after a lot of time away and working from home and reassessing and reappraising the value on offer within stock markets. I personally think that the Delta variant and its spread is more of a red herring for equity markets at the moment. And the two things that matter most are the trajectory for growth and earnings growth in particular. And in many sectors, given the strength this year, it's likely we'll see an earnings recession next year. And valuations are still, in the US particularly, but in Europe too, elevated to extremely elevated. in the face of a taper tantrum or a potential tapering around the world central bank. So you've got a little bit of difficulty on both the growth and the valuation perspective for markets next year. And I think as people come back and they reappraise, they'll probably be taking some profits, looking for lower risk alternatives to park their capital for the next 6 to 12 months while they wait and see.
Freddie, where do valuations look most extended for you at this point?
They're most extended in the broad US tech market, but also across the whole of the market. The S&P, I think, probably is on 22 times earnings next year. Historically, that's been closer to 16 times. And earnings estimates for next year, this year, earnings have surprised to the upside more than any year in the last 10. It's been a very, very strong earnings recovery, a very broad-based strong earnings recovery across the American market. Next year is unlikely to see that. It's going to be a very, very difficult year to beat earnings from this year. And yet estimates are pricing in a lot. So that's 22 times what I think is an elevated earnings number, which is sort of 20 to 25% higher than history. Now, bond yields being at this level justify a higher equity market. And there's no such thing as absolute valuation. It's always relative. But I do think that's still where the greatest risk is from a valuation perspective.
Right. And so what kind of level on, say, the US 10-year would give you a real reason to be nervous about equity markets relative to bonds then, Freddie? Because we are at 1.32% on the US 10-year. What kind of levels would we have to talk about there to undermine the cause for continuing to hold stocks?
I think it's a function of two things. So the level is what should drive it. And I would speculate it would be somewhere sort of closer to 2.5% to 3% on the US 10-year before the level really mattered. But there's also a function of the speed with which we get there. We saw a wobble in sort of growth stocks as the 10-year bottomed earlier this year and moved up quite sharply, even though it only got to 1.6, 1.7. And so I think if you start seeing an acceleration in yields picking up, that could also spook the market and take some of that valuation premium out, irrespective of quite where the level is. But I think if it moves more slowly and steadily and the Fed manages to walk the tightrope, it will need to get to 2.5% or 3% before investors really see it as an attractive alternative to equities.
Okay, Freddie Late from Latitude Investment, the CIO there, staying with us. Thank you for those insights. Coming up, we take a look at the stocks on the move this morning. One big name, of course, is EasyJet, currently falling about 14%, 13.8% or so on a stock sale, a rejected takeover offer as well. The details on that next. This is Bloomberg.
Can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
There is wide disagreement on whether we've seen the worst of the Delta variant in terms of the upsurge in cases. Where do you fall on that?
So I see that the curve is continuing to go up, which is worrying. What is making me really nervous today is that there is this accompanying surge in deaths as well.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Last night we were at a dinner at a restaurant, And as we were walking out, a man walked over to me and said, "Thank you very much. You paid for my daughter to go to college." And basically, I get that all the time. It's the most unbelievable thing. That's my job.
Welcome back to the Open. We are 8 minutes into the European trading day. Red across the board. The benchmark stock 600 is down, currently 0.7%.
Let's have a look at some of the stocks that are on the move this morning. And we'll start with Germany's Merck KGaA, of course. And they're doing a presentation today, which seems to be giving a bit more detail on strategy from here. The company saying new healthcare products, semiconductors and technology for pharma clients will fuel growth in the coming years. They want to boost investment by more than 50% as well, with a high single-digit billion euro amount available for acquisitions. And that seems to be pushing the stock a little higher this morning, up by 2.2%, Tom.
Yeah, and talking of acquisitions, EasyJet brushing off an offer, a bid, unsolicited, it said, also raising, and this appears to be what's weighing on the stock price, raising £1.2 billion via a share sale. The stock, as you can see, currently down 8%, fluctuating there, as you can see on EasyJet, but negative sentiment on the back of that share sale.
Yeah, so the share sale dominating. It took a while to sort of settle, didn't it, this morning, that EasyJet share price. Assa Abloy, this is a really interesting one, talking of M&A. Shares on the rise this morning. It seems that analysts are giving a thumbs up to the Swedish lockmaker's plan to buy Spectrum Brands. That's a hardware and home improvement business for $4.3 billion. So interesting that the company manages to make a gain despite being the acquirer in this particular M&A situation. Let's focus in on the UK food sector then. And Morrisons Supermarkets has reported a decline in pre-tax profit for the first half of the fiscal year due to higher direct costs linked to the pandemic. Despite this, the company finds itself in a bidding war between two US private equity firms as they try to snap up Britain's fourth largest grocer. Bloomberg's Leanne Gerrans has more.
The US is about to take over one of your favorite UK supermarkets. Us Brits have always been spoiled for choice when it comes to food, with the big four, Sainsbury's, Tesco, Asda and Morrisons, and even the German discounters Aldi and Lidl. That might be why US and UK private equity companies are trying to take a bite. In the past year, Asda has already fallen to a large consortium led by TDR Capital and Issa Brothers, and Morrisons could be next for a sweet deal. US private equity firm CD&R is raising its offer for the northern-based supermarket to $7 billion. This comes amid a bidding war with Fortress Group for the UK's fourth largest grocery store. So why are US buyout firms vying for the smallest of the big four supermarkets? Well, in part, it's because Morrisons owns 90% of its 500 stores, giving it a very profitable real estate portfolio. And secondly, they have lots of room for online expansion, which makes it attractive to big US buyout firms who are sitting on lots of dry powder and who are desperate to do a deal. Well, what does this mean for Sainsbury's? The UK's second largest supermarket has been attracting lots of interest since its failed merger with Asda last year. It does not own as many of its own stores as Morrisons, but the shops that Sainsbury's do own are in affluent parts of the country, and its online business is expanding fast. That's enticing large shareholders who are keen to do a deal. Now there's already rumoured interest from US private equity group Apollo, who lost out on a chance to take control of Asda. In a complete turnaround for a sector which has been ignored for years, in the next 12 to 18 months, 3 of the big 4 could be owned by private equity.
And that was Bloomberg's Leanne Gerrans reporting there. Freddie Late, Latitude Investment CIO, is still with us. Freddie, you're a holder of Tesco's. How do you look at some of the changes then that are unfolding in the supermarket space here in the UK? Is this potential takeover of Morrisons, this is a challenge for Tesco?
I think it's a very good news for Tesco. I think the issue with Tesco's share price is that people have found it very dull for the last few years. It's been going through a meaningful transition under the new CEO, Dave Lewis, who's left now, and we've got another new CEO, Ken Murphy. The turnaround's been fantastic. They fixed their cash flow and everything else, and it's now growing substantially, and they are the largest online grocer in the world with the greatest footprint and the largest market share, so trading at around 9 times earnings. So the valuation and the value on offer in Tesco's is huge. But at the moment, people's eyes have been drawn elsewhere, and it's nice to see private equity interest in the sector highlighting the value on offer in the supermarkets more broadly. There is obviously reason to believe in disruptive technologies around the world and invest in technology too, but there are some of these old economy stocks that have been really left behind. So I see it as positive, and I think having private equity ownership in a very competitive market probably allows a little bit more rational pricing behavior in the next sort of 5 to 10 years, which is again very good for the business. So I see this as positive for Tesco, and just reflects on the value that's on offer, the huge value that's on offer in the largest supermarket in the UK.
Okay, that's an interesting perspective then on the role that PE ownership would play in this such an important sector, of course, Freddie. What do you make of the level of interest we're seeing from private equity in UK assets broadly? There seems to be a line of argument that maybe public markets aren't valuing UK assets correctly. This was certainly talked about at the time we saw a lot of this M&A coming forward for supermarkets, but it's been referenced in other situations as well. Is there a problem with UK assets and the valuations that public markets give them?
I believe there is, and we've done quite a lot of work on it at Latitude, because the UK market's always been more interested in dividends, and there's lots more income funds here than there are elsewhere. And I think that's in part driven corporate behavior to push for more dividends as opposed to buybacks as a source of capital return. But if you look at the successful mature industries in America, for example, buybacks have been an integral part of turning their latter 20 years into a great compounding story and a great ownership for those that want to continue to be shareholders. And I think the lack of buybacks in this country is genuinely affecting the valuation on offer in some of our, and we do have a more mature set of companies in the FTSE 100 compared to other countries. And I think that is one of the key differences. There is no buyer for these stocks. Instead, private equity is coming in and underpaying on the intrinsic value. But our businesses are very cash generative and have the ability, just not the willingness, to invest in their own capital, take that share count down over the years, as well as investing in their own business. Possibly even lowering the dividend to do so, I think would be financially wise in almost every scenario we've looked at.
Okay, that's really interesting. I mean, some people don't like the idea of more share buybacks because they say you should be doing something else with the money. Is that not something that applies in the UK for you, Freddie?
Well, the first thing is we have a much higher dividend yield, more like 4% compared to sort of 2 or 3 elsewhere. So you could already take a bit off that, and you're not doing something with the money if you're returning it through dividends. And if you're in a mature business, the better thing to do than spend money on a low return project is to give it back to your shareholders and allow them to recycle it elsewhere. And you are doing something with your money in many senses if you're buying back your own stock, because you're making an investment in something you know better than anybody else. You can tell if it's undervalued, and the lack of buybacks doesn't give other shareholders confidence that you don't believe your stock's undervalued. So I think it can be very, very fruitful, and there's lots of stories of successful stocks over the past which have retired 80, 90% of their stocks, shares outstanding over 20 years, whilst also investing sufficiently in their business to grow. And I think that's a model we should be adopting more here.
Okay, Freddie, looking across the Atlantic to the US, your holdings, I'm interested in your holdings on US banks, Goldman, JP Morgan, Bank of America. To what extent are you optimistic that the yield story is going to change significantly or enough to propel further upside for those kind of stocks? Do you need to see the 10-year edging significantly higher to give those kind of holdings more momentum from here?
Yeah, the great thing about having those banks in the business, I mean, they're all three great businesses, fantastic long-term holds. But the great thing is they do offer a little bit of portfolio protection against higher rates. We were talking about it earlier, and the potential risk to a valuation tantrum around higher rates. So it is nice to have. But the sort of, the impact on earnings, I think is something like, 15% for Bank of America, less than 10% for JP Morgan, and more like 5% for Goldman Sachs for every 100 basis point parallel shift in the yield curve. So it's helpful. It would be a very nice sort of optionality on the stocks, but it's not why we own them. These businesses have grown their book value per share double digits, peak to peak, trough to trough, through the financial crisis and beyond, through coronavirus crisis. They were trading below book value when we bought them. They have since doubled, but they're still trading very, very reasonable valuations, sort of 10, 11 times earnings, with that optionality, not pricing in any move in interest rates, which is likely to be skewed higher. With a high return on capital, I think JP Morgan's latest return on tangible book value was 18%. You know, this is, they are just set very, very well for the future, offering an essential product with a high return on capital. So I think they've been completely ignored because maybe people think they're just macro trading instruments, but we see them as much more than that, high quality businesses with optionality around the interest rate move.
Freddie, interested in your views on China. Is it investable for you? Would you want exposure to that market?
No, we've excluded China since we launched the business 5 years ago, so we don't invest in China. Obviously, having exposure to the growth and the money creation in China within your portfolio can be a positive, but investing domestically in China, as we've seen, and this applies to many other emerging markets too, not all of them, but to many, it is very difficult to know what you truly own and to have that confidence when you're taking a 5 to 10 year investment horizon, which we are with all of our positions, to know that something won't change from the regulatory perspective, the government perspective, the political landscape. It just makes it a bit too fraught with sort of sharp downside risk. And obviously that's easy to say now that it's just happened, but that's our theory for holding off investing in emerging markets. Try to get exposure to the growth through some of your developed market companies as best you can, companies that sell in, but not companies that are sort of domiciled there.
Freddie, thanks so much for joining us. Really good to speak to you. Freddie Late, Latitude Investments CIO. Let's get a Bloomberg Business Flash. A lot of top corporate news to follow this morning. Here with the breakdown is Laura Wright. Laura.
Thanks, Anna. Online gambling company 888 Holdings is to buy the international operations of bookmaker William Hill after seeing off rival bids from private equity. The deal gives the units an enterprise value of £2.2 billion. Las Vegas-based casino giant Caesars Entertainment completed its acquisition of William Hill in April. It's selling the operations to help pay down debt. GameStop shares fell in extended trading after reporting a second quarter loss that was wider than the analyst estimates. That came off the back of revenues that beat forecasts at the video game retailer. The company says it's planning to become more of an online merchant under its new CEO, a former Amazon executive, but it gave few further details during the earnings call. Bill Gates is taking control of the Four Seasons hotel chain in a bet the hobbled luxury travel sector will rebound from a pandemic-induced slump. Gates' Cascade investment agreed to acquire a stake in the hotel company from Saudi Prince Alawid bin Talal's Kingdom Holding Company. Cascade will pay $2.2 billion in cash to boost its share in the Four Seasons to more than 70%. That's the Bloomberg Business Flash. Tom, Anna.
Laura, thanks very much. Laura Wright here in London. Coming up on this programme, we'll get back to the aviation sector and that breaking news story. EasyJet sinks as the airline says it's rejected an unsolicited takeover offer. It also announced a share sale, and that's really having the dominant effect on the share price, down by 8% this morning. We have all the details next. This is Bloomberg.
Welcome to El Zonte, known as Bitcoin Beach. This little surf town on the coast of El Salvador is one of the first to go full crypto. Yep, you heard that right. Everything from groceries to coffee to salaries and community projects can be paid for using Bitcoin.
It's actually been crazy how fast it has caught on and how useful Bitcoin's been for, everyday people.
Just to buy something as simple as a cup of coffee can be done quickly, painlessly.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
China has been focused for a long time now on catching up to the United States in space when it comes to space exploration, and they've really made a couple of really impressive achievements. For instance, in May, China landed a rover on the surface of Mars. It's only the second country after the United States to manage to do that. In June, China sent astronauts to its space station, which is still under construction. China is not part of the International Space Station because the United States worked to exclude China from that. But instead, the Chinese are working on their own. That's scheduled to be in full operation, I think, next year. The Chinese have really come a long way in space. That said, all of that's run by the Chinese government. There is a role for Chinese companies to play in the space program. They're not being as front and center, say, as Elon Musk with SpaceX or Jeff Bezos with Blue Origin. China's companies are playing a more supportive role, I think it would be a fair way to say it, working on things like satellites, rocket launch operations. They're leaving the really big, sexier items when it comes to space exploration, leaving those to the Chinese government.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open. 30 minutes into your European trading day, here are your top stories. Decision day. Investors await any changes to the ECB's bond buying program as rising Eurozone inflation energizes the hawks. Takeover turbulence. EasyJet says it's rejected an unsolicited approach because it undervalues the budget airline. Plus, Morrisons misses. The supermarket chain disappoints with its earnings. What impact will that have on the bidding war for Britain's fourth biggest grocer? So, Tom, M&A speculation aside, and that's certainly only very much part of the story over at EasyJet, it does seem we're caught in a bit of a gloom here for European equity markets, even if not quite as much as yesterday.
For me, technology really stands out because you saw the NASDAQ under pressure yesterday. It was Facebook and Apple that led those losses. Then a handover to the Chinese session and the Asian session, where again, the regulators hauled in the likes of Tencent and NetEase, those big gaming companies. They were dragging down the Hang Seng Tech Index down at more than 3.8%. And the handover has come over to European session as well. When we break down the sectors, which we will do shortly, you'll see that the IT and technology shares are lower as well. A couple of other key themes on the central bank front. You had the BOE's Andrew Bailey saying that the minimum conditions appear to be met for tightening. Kaplan over in the US talking about the need for tapering faster sooner rather than later. And of course, the focus on the ECB and what happens with the PEP program and the decision later today from Christine Lagarde and co. The Stocks Europe 600 down 0.4%. The FTSE 100 is lower than the other benchmarks in this part of the world, 0.8%. It's the FTSE 250 where EasyJet is proving a drag. The DAX is down by 73 points and the CAC 40 is also lower by 0.4. Let's look at the sectors then and see how this is playing out across those different segments of the equity indexes here in Europe. It's real estate that is the only part of this equity complex that is positive at this point in the session, up 0.2%. At the bottom, you've got travel, leisure, energy, basic resources, banks, insurance, retail. The list goes on. You've got telecom and IT in there as well, leading some of those losses. That is the picture here, 30 minutes into the trading session in Europe. Anna.
Let's get to another story this morning then, Tom. Away from the publicly traded markets, Lloyd's of London has swung back into profitability in the first half of the year. That's as the specialist insurance market reported a £1.4 billion profit after it saw substantial pandemic-related losses, of course, last year. Joining us now, I'm pleased to say, is Bruce Carnegie-Brown, Lloyd's of London chairman. Bruce, very good morning to you. Thanks very much for coming to talk to us. Restoring profitability, £1.4 billion. How normal are things, not in terms of your everyday, the ways you're doing business perhaps, but how normal is the market right now compared to last year, which was clearly very impacted by the pandemic?
Well, good morning, Anna. Yes, indeed, still affected by the pandemic this year as well. We've had some £2.8 billion of COVID-related claims in our first half results, of which we paid already $2.2 billion. So the impact of the pandemic very much still there. But actually, the reason the results are as strong as they are is the remediation work we've been doing on the overall portfolio of the market. So pushing out bad business, trying to attract better quality business, an improvement in our expense ratio, and some benefit from increased pricing. But a pretty normal year of claims so far. We've paid out more than £9 billion in gross claims in the first half of this year, which, in using your words, is a pretty normal year.
Bruce, where are most of those claims coming from? Is this climate related? Is it pandemic related? What makes up the bulk of that $9 billion?
Well, of course, there's a huge variety of things. Many of them are what you might call regular attritional claims, high-frequency events. There have been a number of natural catastrophe events in the first part of this year, wildfires, the extraordinary Texas ice storms in February, flooding in Holland and Germany. Obviously, we've also got Hurricane Ida coming through. That's a second half issue in terms of the financial impact, but a very significant hurricane in the United States just in the last couple of weeks. So, you know, our sense is that the natural catastrophe events are increasing in frequency and severity. We have to be careful not to overreact to that, because sometimes weather patterns do occur in that way. But we have seen in Lloyd's results in the last several years the impact of above average natural catastrophe events, and our models essentially kind of are reworked on an annual basis with new data, and of course we reprice our risks on an annual basis. But models tend to work on a linear basis, and if we're really seeing a more exponential development in natural catastrophes, then that's something we have to keep an eye out on. But at the moment, absent other issues that we can't predict, of course, in the second half, it looks to be a really reasonably normalized natural catastrophe year in aggregate so far.
Okay, that's really interesting. So, I mean, you're clearly very used to insuring against catastrophes, Bruce. Let me stick with the green theme, but from a slightly different angle. You've come under political pressure, and campaigners have targeted Lloyd's of London, just as they have a number of other city institutions, to argue that maybe services should not be offered to companies that are still operating in the coal space and others. You've provided guidance to your members. You've suggested that to your members they need to transition away from providing insurance to certain parts of the energy space. What kind of feedback have you had from members about your intentions to transition to a sort of greener future?
So members of the market recognise that the insurance industry has an important role to play in the transition to a decarbonised economy globally. But crucially, we want to support our customers in that transition, and where possible, we do not want to create cliff edges. But there are certain things that cannot transition. A thermal coal mine is always a thermal coal mine. It can't become anything else. And so the market is making a determination that it doesn't want to underwrite new thermal coal projects, the same with Arctic drilling and oil sands. But we're also working with the broader industry, the energy industry, to try to understand the transition of their business models so that we can support them. And if we believe that they are transitioning in the right way, then we're right to continue to do that. But where we don't think they're moving or moving fast enough, we may have to make some judgments not to provide them with underwriting support.
Okay, something else that stood out from these results then, the return on capital jumped at Lloyd's of London, but investment income fell. Is that trend expected to continue, Bruce, do you think?
Well, the investment income issue is really a mark-to-market a challenge year over year. So last year markets performed very strongly, and so unsurprisingly our investment income was very strong. They performed less strongly this year, so investment income is down. Our investment portfolio is reasonably de-risked. It's short-term, it's highly liquid, for the obvious reason that we take most of our risk on the liability side of our balance sheet, not on the asset side. And so fundamentally, low interest rates are adverse for our investment income, but unsurprising.
You're talking to us today, Bruce, from inside that iconic Richard Rogers designed headquarters of yours, and I know that you have plans to embark on something of a refit for the hall that you're standing in there. Tell us about your return to office plans or hybrid working plans, or how those evolve, and how that went into your decisions around what to do with what is no doubt a really iconic but also probably very expensive bit of real estate to operate in the City of London.
Well, first, we've been really pleased with the way the market has been able to work remotely. That was our first challenge going into the pandemic, and our business converted to remote working really much better than we had expected. I think now we're in this phase of, as you say, the return to the workplace, and it's hard to predict how quickly that's going to happen and to what extent we get back to the kind of footfall we had before. So we had in this building 5,000 people a week coming into the building. We're at not much more than 10% of that at the moment, but September feels like a kind of back-to-school month, and I would expect to see the volume of returning footfall increasing through the month. But I think we have to remain a little bit flexible to see how people's work patterns will have changed through the pandemic. So this building has actually been open since May, and we are open for business. And we certainly believe that a lot of our business is more efficiently done face-to-face. The complex risks that we underwrite, the risk sharing that we do amongst insurance enterprises. And so there's definitely a role for the physical market. Whether it returns to the same level of activity as pre-pandemic, I think we're willing to be patient and let's see how it develops.
Okay, so that's some of the pandemic impacts. The domestic story, the focus has very much been in the last few days, these tax changes, the tax hike by Boris Johnson, the government here. Looking at tax hikes, of course, around national insurance, corporate tax hikes as well, the continuing impacts of Brexit. Is there a risk, Bruce, do you think that the UK will be losing, is losing, has lost its competitive edge?
We're not seeing that for our market. First-year results show increases in revenue, and we're also benefiting from price rises for reasons we've just discussed. I think international travel is quite important to us. We want to be in front of our customers, and so the absence, for instance, of access for people from the UK to the United States is something that worries me a bit, and I hope can be corrected. There are certainly friction costs associated with Brexit being felt across all industries, including ours. We've put in place kind of post-Brexit measures to try to continue to service our customers, but some of those things still need to settle down. So not easy, but I'm not concerned about the competitiveness of the UK at this point.
Okay, Bruce Carnegie Brown, Chairman of Lloyd's of London, moving in to profit, breaking down those results for us and the view on the UK economy. Thank you very much indeed. Now we have a line across just in the last few minutes. There's a redhead on the terminal just updating more news on the regulatory squeeze that we're seeing in China. China will halt the approval for new online games. This is according to the South China Morning Post. This after, of course, Tencent, one of the biggest and most valuable companies in Asia, and NetEase, both major developers of games, were hauled in by regulators earlier today and told to focus on the question of whether they need to continue to derive profits from their gaming businesses. Games, by the way, provide about 30% of Tencent's revenues. Currently, Tencent listed in Hong Kong is down close to 8%, so another leg lower for that major Chinese tech company. Anna.
Yes, and interesting to see the read across into Europe through that well-trodden path through Prosus, which has a shareholding in Tencent. That stock down by 5% now in the Dutch market. Let's leave that there for one moment. No doubt a theme we will return to, regulation of all sorts in China and the gaming sector, very much on the list there. Let's get a Bloomberg First Wave News update. Here's Laura Wright.
Thanks, Anna. Following on, China's factory gate inflation accelerated in August to a 13-year high, with commodity prices remaining elevated despite Beijing's battle to curb gains. Producer prices were up 9.5% from a year earlier. CPI, meanwhile, gained 0.8%, less than the 1% forecast by economists. Lawyers for Theranos founder Elizabeth Holmes said she isn't the villain that prosecutors have made her out to be as her criminal trial begins in Silicon Valley. Holmes faces 10 counts of wire fraud and 2 counts of conspiracy to commit fraud, tied to claims of revolutionary blood testing technology at her failed startup. Theranos dissolved in 2018 after she and former executive Sunny Balwani were indicted. European farmers can now feed bugs to their chickens and pigs in a major boost to the growing insects industry. The EU rule change comes into force this week. Rabobank estimates the market for insect feed has the potential to reach 500,000 tons by 2030. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Anna.
Laura, thanks very much. Laura Wright here in London. Coming up on this programme, we focus back on the ECB as the central bank has its first chance today to convert its strategy review into concrete action. What does that mean in practice? Details next. This is Bloomberg.
What do you predict the Taliban will do in the coming months and years?
I would say consolidation of their power and gaining international legitimacy and recognition. This is the priority for the Taliban, not supporting transnational jihad, not basically in any activities outside of Afghanistan. If you really watch carefully what the Taliban have done in the past few days, they are engaged in a public relations offensive. They are trying to convince the world. I mean, if you listen carefully to what they're saying, you think that the Taliban are newly born Democrats. They are peacemakers. And the reason why they want to consolidate their power, they want to convince the world that the Taliban have changed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think we have all the firepower we need and we will use it. This is the message we give to anyone. And it was always the idea behind our fiscal strategies. So we will have a public investment of the federal level of 50 billion euros a year in the next years. It will be a decade of high private investment and high public investment. What we are doing is, for the first time, creating a big package to fight against the crisis with the means of the union. And the Hamiltonian moment in this is that we also agreed on paying back the debt back. After the last big flood, we invested approximately 6 billion, and it will be obviously more this time, but it will be something we can afford and we will afford.
And that was, of course, Olaf Scholz, Germany's current finance minister, on the country's spending. To learn more about the man who is now the front runner to succeed Angela Merkel, you can read our full profile of Scholz on your Bloomberg. Just go to TopGo or Bloomberg.com. Okay, sticking with Germany, ECB policymakers will have to decide whether they dial down their emergency stimulus later today. Eurozone inflation has surged, but the hawks on the governing council may still not get their way. For more, let's get out to Frankfurt and our reporter Maria Tadeo, who is there keeping very busy as ever. Maria, the ECB expected to revise both the growth and inflation protections or projections, fodder potentially, depending on how that plays out for the hawks and the doves. Where are the investment community? Where is the key focus, do you think, today?
Well, you know what, Tom, when you look at the GDP, we already had a very strong hint from the Vice President of the European Central Bank, Luis de Guindos, kind of saying, you know, the economy is doing better than we expected. You know, a lot of this is because of the vaccinations, so there could be an improvement on that front. But it really is the inflation and that CPI print, especially as you head into 2022 and 2023, that is the focus. We know that right now there's a very intense debate in the Governing Council. We've seen the hawks come out in force over the past 2 weeks, the Germans, the Dutch, the Austrians, saying we do look at prices and we say that perhaps this is not transitory. It's becoming much more structural than initially thought, and that should mean that we need to tweak our policy going forward. So in particular, that CPI 2023 data point will be a focus here, and it will also be interesting how Christine Lagarde deals with this to try to say, well, we have an economy that is improving, but we still see that inflation is just episodes of price increases that we're seeing. This is not something that's systemically a problem. Remember, until now, that had been the official line of the ECB in those council meetings.
Now, the market is also going to be focused, Maria, very much on the language around asset purchases. When is a taper not a taper? Should it be looked at as the same as the Fed if the ECB does today or in the future decide to dial back its purchases? It's a complex one.
Yeah, and you know, back again, we're a significantly higher watch. Remember, that was a line that the market and investors really cared about before, and they use that as a guidance to determine how much the European Central Bank will be buying. You know, if you assume that right now it's about 80 billion and that line changes, it's not significantly higher, but it becomes something that suggests perhaps just a constant rate or a wording that dials down that pledge, then you could argue they're going for less. But the tricky point here, and the officials that I've been speaking with in Frankfurt also point to that, is that you don't want to make this look like a taper. The ECB is not going to stop their stimulus program. They're tweaking. They'll talk about recalibration, but this is not a taper, and this is not a situation that is comparable with the Fed. Europe and the United States are in different paths when it comes to monetary policy at this point.
Maria, thank you very much. Maria Tadeo live for us in Frankfurt. Another one of our top stories this morning, new news lines on it, and that is what's going on at EasyJet, the low-cost aviation sector. We heard from EasyJet earlier that somebody, a business, had made an unsolicited offer for EasyJet. They did not reveal who. It seems our reporting has now revealed that this suitor was Wizz Air. Wizz Air was the mystery suitor that made a takeover approach for EasyJet. This is according to our reporting, people with knowledge of the matter telling Bloomberg. The Eastern European discount airline made this offer, an all-stock takeover for EasyJet, asking not to be, the people asking not to be identified. EasyJet said it had rejected this and also said that the suitor was not coming back. And certainly the share price reaction today that we're seeing in EasyJet suggests that the market is very much more focused on the equity market issuance, the stock issuance that we've seen from EasyJet overnight, that also making news. And that is the market's focus rather than any takeover approach. But it strikes me as fascinating that we've had this approach then, Tom, from another player within the sector, such complicated regulatory rules surrounding aviation about who is allowed to own whom. That certainly limited the potential list of suitors a little bit, and indeed competition regulations would have come into it if it had been, if it is a rival airline, and it seems as if it is a rival airline. We'll see if that is the end of the story or not. The UK market hot for M&A.
Yeah, and it was also key, isn't it, as to what it tells you about where these executives see that growth coming from in terms of that cheap level of travel,
yes.
Those cheap seats, right? And to what extent are things going to be bouncing back post-pandemic as some of these conditions change in terms of borders?
Joseph Ferrari, the CEO of Wizz, has been very optimistic relative to other executives through the pandemic in his conversations with us. So a fascinating sector to watch here as it rebounds. Coming up on the programme, we assess the key takeaways from the Fed's Beige Book. Market Live team member Ben Ram joins us next. This is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European market open. 54 minutes into our trading session, some weakness across European equity markets. Most sectors in negative territory, but not perhaps as weak as we were yesterday, if that's any kind of silver lining for those longer the markets. Ben Round from our Markets Live team joins us right now. Ben, good morning to you. What's your focus today? I know you've been looking at some of the data coming out of the US. We had JOLTS yesterday, job openings, also the Beige Book. What did that tell you?
Well, the Beige Book tells us that demand in the U.S. economy is holding up fine, but there are supply chain disruptions. In other words, the report is saying that the consumer is doing all right, and that's nearly 70% of the U.S. economy. That's great news. On inflation, the Fed says price pressures are steady at an elevated pace. In simple English, what they're trying to say is that we have inflation that's stubbornly high. Indeed, we have had 3 consecutive months when the CPI has risen 5% or more, and yet if you look at 10-year treasuries, they offer you next to nothing. So in other words, all investors are getting shortchanged by low real rates. That, to me, is the big takeaway from the Beige Book, Anna.
Okay, Ven, thank you for that takeaway. Of course, looking ahead as well to the ECB. Our Markets Live team, just an update in terms of what's happening with the world's most indebted developer before we let you go. Something of a reprieve, at least in the short term, for Evergrande. It's going to reset its debt terms to ease some of the pressure on some of those repayments. It's been given the blessing of regulators in Beijing. The markets across Europe now down 0.4%. Some big corporate stories, including EasyJet, of course. That is it then for the European market open. Surveillance early edition is up next.
Yeah, the European equity market's definitely on the back foot. And Tom, you mentioned the ECB's coming up. The focus there, as Maria has been telling us, and also guests have been telling us this morning, the PPP, the PEP program, the extent to which they communicate, any winding back of that. So that will be a focus if it is to come to pass from the ECB. And also just how transitory is inflation. So that's also going to be on the market's mind today. This is Bloomberg.
would love to see us sooner rather than later start taking our foot off the accelerator.
We don't follow the market slavishly, but the market curve does suggest that.
We are in a different universe, it seems to me, in the US and in Europe. In Europe, there is flexibility.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Thursday, the 9th of September. I'm Francine Lacqua here in London, and here's what's coming up on today's program. China halts approvals for new online games, while Beijing continues its crackdown on gaming, sending shares in Tencent and NetEase tumbling. From strategy to action, investors await possible changes to the ECB's bond buying program as rising Eurozone inflation energizes the hawks. And the Fed's Kaplan says strong data actually underpin the case for unveiling a Fed tapering plan this month. He says implementation could start in October. So we have quite a lot of news today. Of course, all eyes on the ECB, on what we're expecting the president, Christine Lagarde, to say. There's a lot of belief in the market, and we can kind of see it today, that actually she's not going to spook the market. So every language will be quite careful to try and make sure that the markets understand the timing of some kind of tapering, and they'll probably be at pain. Once again, what we heard from the Fed is that tapering does not mean rates will go up. But European stocks down some 0.4%, maybe some of the airlines under pressure, still renewed concern about the economy. EasyJet, now I wanted to show you this, down 9%. At some point, it was falling even more. This is on issuance of stock, but also the fact that they decided to reject a takeover. If we look at the individual indices, so it is a sea of red. You can see the FTSE down some 0.9%, almost 1% lower. This is also to do with financial, some of the basic resources there. If you look at the FTSE MIB, it's one of the ones that are losing the least, with down 0.4%. Again, if you look at the DAX, the CAC, and the FTSE MIB, it's all about also the deficit. No matter what the ECB says, there will be a lot of questions on whether taxes will need to rise, like in the UK, to fund some of the deficits because of the pandemic. In terms of groups, now I wanted to show you what exactly some investors are looking at. So we're 1 hour into the trading session. Real estate, and you can see industrial goods, the only gainers, some of those concerns coming at the forefront, not only what the ECB will do, but of course what the economy does with travel and leisure. That's largely EasyJet, banks and energy under a little bit of pressure today. So China has fired another salvo at the gaming industry. The South China Morning Post has just reported that Beijing will halt approvals for new online games. That's after regulators summoned companies, including Tencent and NetEase, to discuss further oversight of the industry and the need to de-emphasize profits. Well, Chris Woods, Jefferies Global Head of Equity Strategy, now joins us from the company's Asia Forum to discuss. Thank you so much for joining us, Chris. I know there's a lot of focus on China. I know there's a lot of focus on equities. Do you see more crackdown coming, more regulation happening soon, Chris, or will things actually level out?
Well, logically, they should start to level up. But clearly, the big problem for Chinese equities from a foreign investor standpoint is that most foreign investors in Chinese equities had their portfolios dominated in three sectors, which were internet e-commerce, education and healthcare. And these are the sectors that have borne the brunt of the regulation. E-commerce remains a huge percentage of MSCI China index. But in the Shanghai market, there's been much less carnage because in domestic China, investors are focused on those areas which the Chinese government is promoting, which is areas like semiconductors, electric vehicles, new energy. So there's a divergence between what the domestic market is focused on and what foreign investors owned in China. And because a lot of these stocks were listed in New York, they were easy to own.
Yeah, so what do actually international investors misunderstand about China? Are we reading the crackdown wrong? Do you think it'll be deeper than we're talking about at the moment, or actually will it be more with a lighter touch over many years?
Well, in my view, the Chinese government has not declared war on the private sector, not declared war on capitalism. The Chinese want to upgrade their economy. But clearly, if you only own internet stocks, this crackdown is very bad news, and the internet stocks are going to suffer long-term de-rating because of the various rules which have been introduced, because the Chinese government is changing the rules of the game. And if the same thing happened in the US in terms of big tech, these stocks would collapse also. The difference is we've been debating big tech regulation in the US for 5 years, and nothing's happened. The Chinese government never had a debate. They've just done something about it.
Chris, when you look at global equities, how much further can they go before we get some kind of correction? So this is $1 trillion, $4 trillion, quadrillion dollar question. Is it central banks and maybe a policy surprise that will lead to a correction, or will it be something more fundamental?
Well, a real collapse in equities, in my view, will only be caused by the emergence of a variant of COVID, which the vaccines are not effective against. That would cause a collapse. That would send Treasury bond yields back to the level we saw in the spring of last year. But in the absence of that outcome, and hopefully that doesn't happen, in my view, the only meaningful correction in equities will happen if the central banks start to meaningfully tighten. But in my view, any talk of real tapering will start a correction, and then 9 times out of 10, the central banks follow the market and stop doing whatever they were doing.
Right. So, Chris, where do you see the best value? Is there anything at the moment that looks undervalued that you want to, go ahead on?
No, right now, if I was adding to equities today, the obvious place to add is Japan. Japan is cheap. The earnings growth is fine. It's underperformed dramatically this year for no real good reason. The vaccination rate's accelerating. Yeah, for global equity investors, adding to equities today, my view is definitely Japan.
Yeah, Chris, I mean, we saw when the Prime Minister actually said that he will resign quite a big run in terms of Japanese equities. So is it because you're expecting more stimulus from now on, and how much of it is already priced in?
No, it's simply because the market's underperformed. The big problem for Japanese equities is that domestic institutions haven't raised weightings to the Japanese stocks from JGB since 1990. So Japan can only really have an outperforming moment when foreign investors start buying. But in my view, it's a good time for foreigners to add exposure to Japan, and we can have a catch-up trade in the Japanese stock market. And the topics today, I believe I'm right in saying, is at the highest level since 1991. Fundamentally, though, earnings are okay, and Japan is a cyclical trade. And if the pandemic takes a rest here and we don't get a new variant anytime soon, we should get a renewed rally in the cyclical trade in the coming months.
Chris, can you give me a sense of what you're actually selling off? So does it look, this is what you like, what don't you not like? So what do you think investors should lay off in the next couple of months?
No, in my view, investors should maintain a barbell strategy of cyclicals and growth stocks, because the key issue for equity investors is 2 things. 1, do you own cyclical or growth? And 2 is the inflation pickup we see clearly, transitory as the Fed believes, or more longer lasting. My bias is that the inflationary pressures will prove to be more longer lasting, which is why you want to own some cyclical stocks. But I also believe even if the inflationary pressures do prove more longer lasting, I don't believe the G7 central banks will be politically able to tighten in any meaningful manner. So that will continue to support growth stocks. So basically, I think you should own both kinds of stocks, growth and cyclicals. You should not own any bonds in the G7 world unless you believe there's going to be a variant of COVID which is vaccine resistant. Tactically today, though, I would definitely add to Japan.
Thank you so much for joining us. Jefferies Global Head of Equity Strategy, Chris Wood, joining us from the Jefferies Asia Forum. And later on in the program, we'll also continue our China crackdown discussion with Peter Elstrom from our Asia Tech team. Now, if you have any questions for him, just IB plus TV Go. Decision day. Investors await any changes to the ECB's bond buying program as rising Eurozone inflation energizes the hawks. We're live from Frankfurt next. This is Bloomberg.
still committed to the U.S. pickup market? You mentioned how small it is, and I know you do good business with Frontier, but a lot of times Americans want something bigger like the Titan. Is that, do you plan to stay in that market as competitive as it is?
I mean, for us, market is one thing. The second is what customer aspires for from Nissan. And customer in United States aspire for sedans, SUVs, and the pickups. And Titan is a great pickup truck, and we are, of course, focusing on the Titan. But as I said before, that in our whole lineup, our main focus is always been in the sedans and SUVs and the smaller pickup truck.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's take a look at some of the key events coming up today. First of all, at midday UK time, we have Mexican CPI figures. We'll also be watching the all-important ECB rate decision, expected today at 12:45 p.m. And then at 1:30 p.m. UK time, we'll get the latest initial jobless claims. Finally, NFL fans rejoice. The U.S. National Football League season begins later today. So on to ECB, and policymakers will have to decide whether they dial down their emergency stimulus later today. Eurozone inflation has surged, but the hawks on the Governing Council may still not get their way. We've been getting perspective from some key voices ahead of the meeting.
We are in a different universe, it seems to me, in the US and in Europe. In the US, you had a commitment to purchase exactly the same amount every month, and this is a clear-cut commitment. So tapering means something. In Europe, there is flexibility.
The inflation situation in Europe is quite different from the United States. When the COVID shock came, the economy was, not performing very well. There was still a lot of slack in the economy. The inflation was too low. And so it's a very different situation from the US.
It's a short-term blip in inflation that we're seeing right now. And the hawkish ECB members, among others, the one from my own country, are once again too short-term focused, not looking through the volatility in the data, which we think the ECB at large will do.
There will be hawks being vocal on this, which is to be expected. But given their new guidance, their new outlook, it'll be a very, very long time before they're in any position to tighten.
But we need to watch the doves to see if they're switching. But to be honest, even though there could very well be a reduction in the amount of PEP purchases or the purchases through the PEP plan announced this week, I don't think that Lagarde is going to do anything else but stress the dovish point.
Well, let's get more now from Bloomberg's Maria Tadeo. He's in Frankfurt for us. So, Maria, the ECB is expected to revise both growth and inflation projections. What will the focus be?
Yes, Francine, and when you look at GDP projections going into this meeting, the Vice President of the European Central Bank, Luis de Guindos, pretty much already hinted that they will be revised and taken upwards. A lot of this reflecting that the vaccination rollout has gone better than expected, but also this idea that, while there is still big concerns around the Delta variant, Francine, to see another big lockdown in Europe is very hard to swallow for governments, therefore is becoming less likely. But it really is the inflation print where the attention will be, especially as you head into 2023. There's a huge debate, as you played in that tape, over whether the inflationary pressures are just a one-off, whether this is transitory or not. And we have seen the hawks out in force in the past 2 weeks, saying that this is something more than just a one-off episode. Having said that, and you spoke to Christine Lagarde very recently, the official line until now has been that this is a particular episode that is pegged to specific issues, and Europe is not caught up in a higher inflationary spiral at this stage. So it'll be interesting to see whether or not that data reflects that, especially in the longer-term horizon.
Yeah, it really will be interesting. And Maria, of course, we need to see how they justify the transitory effect of this inflation if it just gets higher and higher. Thanks so much, Maria Tadeo, there in Frankfurt for us. Now, joining us is Burkhard Warnhold. He's a Credit Suisse Deputy Global Chief Investment Officer who joins us on the ECB and, of course, some of the valuations out there in the markets. Burkhard, thank you for joining us. When you look at the ECB and when you look at exactly some of the challenges out there, is Christine Lagarde's main challenge actually trying not to spook the markets that tapering also means a rate hike?
Well, look, I think it's important to take that famous step back and look at this from a big picture perspective. It seems to me that Wall Street in particular is this perennial love affair with people like Paul Volcker, who was the hawk of hawks, if you will. And that blurs the view for what has changed fundamentally between years when hawkish monetary policy was actually supported by real politics, whereas nowadays we've moved full circle, really, from an environment where Paul Volcker was a hero to one where there's absolutely no political majority, neither in Europe nor the United States or Japan, for a truly hawkish or tight monetary policy. So not only do I believe that inflation is limited, but I certainly cannot see the ECB or the Fed becoming truly hawkish or tightening monetary policy in this decade, not just in the rest of this year, Francine.
I mean, in this decade, Burkhard, that's a really pretty punchy call. Burkhard, at some point, I mean, is this actually a policy mistake? So at what point does too much stimulus, stop being ineffective, and when does it become harmful?
Well, look, I think there are some fundamental difference between today, or call it this decade, and the time, let's call it the 1990s, the Washington Consensus, the time of deregulation, and where monetary policy was much more independent, at least intellectually. Nowadays, mountains of government debt, just to name one, add to that demographic aging, which is very conservative, and the deep societal and political polarization in all our societies, which leads to an environment where lobby groups from left and right are all calling for the government to give a helping hand, which differentiates this 2020s from the period of laissez-faire, if you will, of the 1990s. And so monetary policy must be seen in the greater picture of where it fits into fiscal and social policy, and therefore it being politicized much more than before, plus the ECB structurally being more easing or more dovish, if you will, because of its fiscal, because of its symmetrical inflation target, suggests that yields will remain zero-bound and negative in real terms for the rest of the year and the decade, Francine.
So, Burkhard, where does that mean you want to see? What are you buying up right now? So is there anything on the markets that you see either as undervalued or actually something that you want to get invested in because it's your genius Credit Suisse idea?
Well, that's a good question. And clearly, in contrast to last year, TINA, there's no alternative, has become a market narrative and consensus. It's not something that would surprise anybody. So what investors should really judge is, where do we go from here? It's true, we've just witnessed the longest bull streak of the last 2 decades without, the third longest bull streak actually, without a 5% correction. But the conditions are there to extend this and make it turn into the longest. We have unprecedented liquidity in the system, both in Europe and in the United States. And some sectors or themes indeed have become cheap. Let me just give you one example. Companies that contribute to the energy transition, to helping others emit less CO2, have actually cheapened this year and pose, I believe, both from a thematic as well as a cyclical perspective, a good investment opportunity.
Burkhard, thank you so much. Burkhard Warnhold there, Credit Suisse Deputy Global Chief Investment Officer. Now, coming up, Beijing continues its crackdown on the gaming industry. Reports say that China will halt approval for new online games. We discuss that with Peter Elstrom from our Asia Tech team. That's a little bit later on in the program. Now, if you have any questions you'd like to ask, just IB plus TV Go. This is Bloomberg.
happening on the ground right now, just in terms of consumer price tolerance?
We see a strong consumer right now, and you can see that even in the early starts to back to school and back to college season that we're really pleased with. And I think if we step back and look at the quarter, we see the evidence of that strong consumer.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Prime Minister Boris Johnson has won a mandate from the House of Commons to raise taxes to fund health and social care. The vote in the UK Parliament passed comfortably, though 42 lawmakers from Johnson's party abstained or voted against the plans, which will increase the tax burden to its highest level on record. Now, lawyers for Elizabeth Holmes, the Theranos founder, have said she is not the villain that prosecutors have made her out to be, as her criminal trial began in Silicon Valley. Holmes faces 10 counts of wire fraud and 2 counts of conspiracy to commit fraud tied to claims of a revolutionary blood testing technology at her failed startup. Theranos dissolved in 2018 after she and former executive Sunny Balwani were indicted. And more than half of young employees in the UK say working from home during the pandemic has taken a toll on their office conversation skills. According to a survey by LinkedIn, 84% say they fell out of practice when it comes to office life, including speaking to clients and, of course, delivering presentations. The research also found that 9 in 10 bosses agreed that young people's professional development had been stunted by the pandemic. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, I love that story. I mean, I don't know. I mean, we're not awkward, but we've also been coming into the office for a long time, right? You're kind of at the, the water cooler moment, and we still talk to each other. But if you haven't spoken to anyone in 18